Hey everybody, welcome to another Ask Me Anything on Wednesday. So it's going to be a small group today, Craig and myself, because we have some people traveling, unfortunately, due to hurricanes and tornado warnings and all sorts of crazy stuff. So for all of you out there that are dealing with the same thing, stay safe, take care of each other, watch each other's backs, all that kind of stuff. But yeah, we've got a lot of our colleagues that are in transition or right now, and actually Steven just sent us a message. He's having tornado warnings where he's at right now. So keep them all in your thoughts. All right, guys, go ahead and put in your questions. I'm going to go ahead and we're going to do a quick little intro and then get back to you. All right, everybody. All right, so I don't see any. We don't have any questions yet. Go ahead and use that. Use the comments, guys. Any questions you have, go ahead and put those in there. Hopefully, you guys can all see us right now and are reading us. Let's see here.
Yeah, and then starting tomorrow, we've got the VIP dinner at the Money Multiplier Masterminds in Nashville, and then the show begins on Friday and Saturday. So I'm just kind of curious who's out there. If you just put in the comments whether you're going to be there or not. Looking forward to seeing you out there.
Yeah.
Yes, Brent. We don't know how to change the background, so we're going to be WTF. Ask me anything.
Yeah, that's right. We're gonna be that for now. But yeah, guys. Any questions you guys got for us? Anything infinite banking related? Anything financial related? Anything hurricane related?
Well, the first question I can take and I'll answer. Craig, will you be in Nashville? Yes, I will. I'm getting in tomorrow morning, so look forward to meeting you there, Brent.
There you go. Cool. How far away are you from there, Craig?
It's 2-hour flight, not too far. Just Denver to Nashville.
Okay, gotcha. Yeah, probably about a 3-day drive for me. So probably.
And, yeah, I mean, I'd like to drive, but.
Yep. All right, guys. Okay, so let's get some questions coming in here. All right.
Looks like James comes in with, how do you get started?
Oh, yeah, so let's really address this question first. All right, so if you max out your PUAs, actually, we didn't do any introductions, by the way. I forgot to do that. So the two of us here. So obviously, Craig, you're down there, closer to the whole fiasco in Florida right now. Do you feel any of the effects of that where you're at?
Not really. I mean, so I'm just south of Denver, Craig Yenny here, and
yeah,
it's just been dry and hot. Matter of fact, I think we're going to skip over fall where the leaves aren't really changing colors; they're just getting dry and falling off the trees. So I feel like I'm getting robbed. Fall is my favorite time, and it's just like what happened to the leaves here? But yeah, we don't tend to get too much of that weather pattern.
Yeah, we don't either. I mean, I get none of it up here in the Pacific Northwest. Yeah, so it's dry. We haven't even had any rain for months up here, so we get none of that kind of stuff up here. So no hurricanes, no tornadoes, just lots of snow in the wintertime. Cool. All right. So Justin, so if you max out your PUA and you have a loan out, you technically can add more into any loan repayments. You max out your PUA and have a loan out, can add more into any loan repayments.
So, Justin, if you have a loan that's still outstanding, you can always pay that loan in full. So let's say you had a $5,000 loan. You can put up to $5,000 plus the interest back into that loan. Now, if you're being honest banker and let's say you had $6,000 to put back into your system because that's what it would have cost you in terms of third-party financing, then we'll try to put that into PUAs. And like you say, you're maxing out your PUAs. Well, if that continues to be the course that you're hitting over and over, you might want to think about another policy or doing something along those lines. But after you pay your loan back and you can't get any more in there, and you won't mech it. Matter of fact, in the companies that we do work with, there's been a few cases where people have sent in too much money. And they'll actually get the money returned with a letter saying, if you put this money into your policy, it will cause it to Mech, which is a modified endowment contract. For those that are here, that just means it's now a taxable entity per the IRS. So the insurance company will send that money back to you. And if you wanted to intentionally Mech it, there are some estate planning things that sometimes we do that. then you would go ahead and sign that letter and send the money back in. But they're not going to let you just mech the policy.
Yeah.
And so doing a second policy, Joe, awesome. Well, you've already got that problem solved. Then if you've already got your loan filled up, your max PUAs, then yeah, you're ready for your second policy, most likely.
Awesome. Yeah, I've got quite a few people doing second policies right now because they're trying to get more of their money currently into policies in preparation for the next 18 months, so to speak. So yeah. All right, let's look here. So, all right, Michael. So he says, could you talk a little bit about the death benefit part of IBC for people who are not interested in leaving a legacy? Could a policy be designed to have it cover long-term end-of-life care? So, I mean, yeah, if you're not really worried about the death benefit side of it or the legacy side of it, what I would typically recommend doing is building a policy to where later on in life, you can then deplete the death benefit, so to speak, by taking loans out of it for, those kinds of things, long-term care, end of life kind of stuff. And that reduces the death benefit. But if you don't care about it, then that's a pretty common strategy for your retirement as well. Now, I will say one thing, though, and then Craig can take this one. But when we look at whole life insurance, we typically don't use the words long-term care or end of life, even though they do have some aspects of that, because long-term care is actually a separate product. So long-term care coverage, you can purchase that as a separate thing. Long-term care is meant to provide continual income to take care of long-term care, whereas life insurance is more like lump sum kind of stuff. So Craig, can we add to that?
Yeah, so my thoughts on that, exactly, it's not a long-term care policy. However, the cash value can be used for long-term care, or it could be used for end of life. There are, in some companies, they have riders such as terminal illness or chronic illness riders. And in long-term care speak, if you can't do 2 of the 5, daily living things such as feeding yourself, bathing, clothing, toileting, so there's certain things that you have to qualify for. The insurance company, depending on certain points of the policy's life cycle, you can actually get access to some of the death benefit early if you do make those qualifications, if you have a terminal illness or if you have chronic illness where you don't meet 2 of the 5 daily living activities. So
yeah,
it can double there. And then I think the last thing I'd say just about the legacy piece is, even for folks that don't have anyone to leave a legacy for, I'm sure there's some cause out there that you might, so you've got some beautiful background, maybe you want to leave it to, a conservancy or, land, to make parks. I mean, there's got to be a charity or something out there that you can just go ahead and, leave that the rest of the legacy to if there is no one else.
Yeah.
And if you don't have anybody, I am happy to take that place for you. So
there you go. Yeah. And by the way, also, and later on in life, you can also sell policies too. Now, if you have them, you can also sell them for, money and that kind of things. People will buy policies. So that's not something we typically talk about, just because it gets kind of a little bit unique and it's case by case, but that also is an option as well.
Yeah. And Brian, just one more thing on that whole subject, because you kind of talked about taking loans or withdrawals. So, if you're wanting to just kind of take as much of that money out of that policy and just kind of leave it as a shell, we don't want to take so much out that it lapses, but
right.
You can take withdrawals from that policy as well. So over time, you're going to be getting way more out than you put in. So you could continue to take some withdrawals during retirement. So that might be an approach for you as well.
100%. Brent said, Craig, we need to start policies on our for-profit.
Aha. Yeah. Yeah. So we've got some policies going with Brent for his not-for-profit or non-profit. So yeah, we'll let's talk about that when we get to Nashville. Yeah. Joe will be there. I'll be there. So let's sit down at the table and chat about it.
A question on that one, Craig. So something came up with a client today. This is a good question, good kind of segue. They were asking, hey, if we have a non-for-profit, like a church or something like that, does that affect the Mech structure of a policy?
So the Mech is still going to be applicable. So we still have to work within those rules, but you can certainly still create policies for not-for-profits, nonprofits. And what's interesting about that is if you have major donors that do consistent, donations to your your charities or whatever it might be, they are an insurable interest. So it gets a little more creative when we start looking at some of those other types of organizations. You can insure people inside of that organization, but you can also find reasons to insure people outside of that organization.
Now, since a church or a charity is not taxable, is the Mech, if they have a policy that is a Mech, is it taxable then?
Yeah, I don't know. I'd want to defer that to a CPA. Well, maybe Chris is here. Maybe he knows.
Yeah.
Did you hear that last question, Chris?
No, I've been having nothing but internet problems trying to get on here. So just popping in. What does it say?
Yeah. So it's one of our clients. They're working with a church, and so they were asking about if you have a church that is a charity, of course, or a not for profit. If you have a policy, can you build it with being a Mech and have it not be taxable because it's a charity?
So yeah. Like if the foundation or the charitable organization owns it, then I would absolutely believe so. Now, again, check with your CPA or tax professional to verify that, but I'm almost certain you can. Yes.
And would that be a benefit to have it be a Mech versus a non-Mech?
No, not necessarily. I would always prefer to build it as a non-Mech. I mean, the way we build the policies nowadays, it really, outside of like a single premium dump it, like, if the charity had like a chunk of money they wanted to dump in, and that would Mech the policy right away. Outside of that, if they're just going to build it, the way we build all the policies, then don't Mech the policy. I mean, I'm trying to remember all the rules. And again, I'm not a CPA, so I can't really give tax advice, but there are some unique rules on how it works within the foundation. I don't think the Mech is as big of an issue inside the foundation. However, you might as well just build it to not be a Mech, so you don't have to worry about it if you ever do move the policy outside of the foundation.
Okay, that makes sense. Yeah, and kind of interesting, situation here. There's an individual who is doing a presentation in front of his church. They're the executive team, I guess, and one of the people on that team is the executive for a local credit union. Okay. Mm-hmm. And he didn't know this, but I kind of coached him on what to say a little bit. And come to find out, that credit union owns life insurance policies on all their executives, including the guy that was in the presentation.
Yeah, that's not Oli. That's it's like CU Oli or something. I'd have to look it up.
Yeah,
it's like credit
union. I found it. It's a credit union owned life insurance. I found the whole thing on this.
I don't know how you say that. CU Oli. CU
Oli. CU Oli.
What's cool though is this is my client. He's like, "Hey man, this is awesome because what you told me to say actually, since that one gentleman had policies, it just affirmed what he was saying in front of the entire group, and so they're looking to potentially do policies now awesome. With the church. So yeah, really cool. Really cool.
I got a guy I know that owns a bank in Texas, and he's same thing. Like him and his family own the bank, and it's like the oldest bank out there. And we were having a long discussion the one day, and he's just talking about like, yeah, our bank owns whole life on all of us. He called it bully, and he's like, yeah, all banks do. And I'm like, it's funny that nobody knows this.
Yep, just do what the banks do, just bypass them. All right, here's another question here from Brian Richardson. At one point in time, I heard you mention plans for a done-for-you opportunity. Is that available, or any mentorship for newbies in Private Money Club?
Well, that's pretty interesting. Craig, do you want to hit that one, or you want me to hit it?
You can talk about why don't you take it, because you know more about the done-for-you pieces of it.
Yeah, so that service is still on the back burner. When we went to our SEC attorneys, to just like anything, you get these great ideas, you bring it to the attorneys, and they're like, well, let me open the law book and talk to you about so essentially to do the done for you the way we wanted in PMC and also with BYOB. Essentially, it requires a financial advisor, like an investment advisor with a Series 65 license. So we've got 2 people on our team right now going through the testing for Series 65, and eventually we'll have an RIA that we open up. It's actually all done. I just need to push go, but I need a licensed individual and compliance officer to run it. So we're close. I'm boring you with the details. We're close, but it won't be till 2025. But it is still coming. It's just, if you're going to do something, you got to do it right, and you got to do it legal.
Yep.
And the other piece I would add to that is the second part of that question was, is there some mentorship within the Private Money Club? So we have a program called the Accelerator. It's an 8-week program. So Brian, you could engage in that. It'll walk you through how to either be a lender or borrower, depends on what side of the fence you're on there. But that's a really comprehensive course that'll walk you through how to become a private lender if that's what you're after.
Cool. Yeah, I get quite a few questions on that.
Yeah, and then we've developed, as part of that done for you idea, we start developing tools, and one of the things we can show is if you're putting money into private lending from a policy, kind of how does the whole money flow? So we have some tools that can show you the short-term and long-term outcome of all that. So all of those pieces, I think, would be really beneficial to you.
Awesome.
Absolutely.
Cool. All right. Next up, that little brown dog. All right. He says 29 years old and investing 25% of each paycheck. That's awesome right there. I love that.
Heck yeah.
Making about $35K yearly after tax. What would be the best strategy to use IBC or infinite banking to make my money work as hard and as fast as possible to replace my current just over broke job?
Look, Kyle, if you're saving 25% of every paycheck, it would not take you long to get to the point where you could replace that job. But I mean, it's just like anything else. We got to capitalize the banking system first. Once you get that capitalized banking, and listen, there's different milestones you could set, so it's different for everybody. But once you get it to a certain level, then you start making that money work for you. I don't know if it's private lending or, whatever, like, and understand that you would want to invest in. Once that money gets working for you and you start recapturing and recycling that back into the policy as loan repayments for the initial loan, that's when things start going really fast. Like they go faster and faster and faster. So, depending on at your age, I mean, my God, you're 29 years old. Like you could probably set up a 5 to 7 year strategy doing what you're already doing with the amount you're saving and probably be to the point where you'd be pretty darn close to being able to replace $35,000 after tax. Because, the beauty is if you could find a way to replace some of that income with tax-free income, now that makes it even easier.
Yep.
And I might be off on the 5 to 7 years. We'd have to run the math, but I can't imagine it taking too long.
Yeah. Yeah. And, first thing, obviously, is if you haven't scheduled a call with one of our team members, go ahead and do that so you can start to get an idea of the numbers and what a policy would look like so that you can start to build what Chris was just talking about, that strategy, that plan and those milestones. But the way I look at it is you've got to plant the seeds as soon as possible because those seeds are going to grow into the, that orchard, as I call it. And so, yeah, I mean, you have the time ahead of you to only make this work. So that's really cool. But if you want to go through numbers with one of our team members, just, grab a time. We'll put the link here in a moment. But that's awesome, man. At 29 years old, I was not saving 25% of my paycheck. In fact, that 3% maybe.
I don't think there's probably less than 1% of 1% of 1% of the people out there that are doing what this little brown bag dog or the little brown dog. I don't know where the bag came in there. Little brown dog, is doing.
Yeah, and it's phenomenal to see that kind of a number because the national savings rate right now is somewhere around, was it 3%, maybe even lower than that.
Is it even that high right now? Might even be lower.
It might actually be lower than 2.5%, but isn't that crazy to think people are only saving 2 to 3% of? That's why we're seeing the debt go up because people are living on the credit cards right now.
Yep. Oh yeah.
Wow.
It's crazy. Well, Hannah.
Hello, Miss Hannah. So Hannah and Chris, are you both in Nashville?
Mm-hmm.
Awesome.
Notice the similar drapes. Oh, yep. You're muted.
Hannah, you're muted.
Hannah, you're muted. Uh-oh.
And now she's frozen.
Well,
we're having major internet issues here at this hotel. Like the phone doesn't work. I got all so mad just trying to, I stay in hotels every week and I was trying to log on to the internet. Like shouldn't be a hard thing. Kept freezing, it took me like 10 times to do it. And then I tried calling down to the front desk. The freaking phone doesn't work.
Jeez. Wow. Well,
hopefully that
bad experience in.
Hopefully that gets corrected before the show starts.
Yeah.
Oh well.
Yeah.
Yes,
cool.
Brian Richardson. Yes, it is. We'll get to that. There she is.
All right. Camo said, there's Hannah. We'll bring her back on. See if she's going to unmute this time.
Mute.
There we go. And
I'm just having bad Wi-Fi problems.
Yeah, both you and Chris. Well, cool. Well, glad to have you on. All right. So the next question we got here says, does it make sense to save money in a policy and use it to pay off debts that have no interest, such as a large tax bill or medical bill, or to save and pay it outside of the policy? I get this question quite a bit.
Yep.
Hannah?
I think Hannah's frozen on us, but I'll go ahead and.
Okay.
Yeah. So the way I would look at this is we want to think about opportunity cost. So if you have $1 in your hand and you go pay down even a 0% bill, that dollar is now gone. It's going to leave your personal economy forever. So if we can just change one place, change one thing, and that's where we put our dollars first, we put them into the policy, we'll then get that uninterrupted compounding for the rest of our life. So in that context, it makes sense to run it through the policy first. But just from a pure math perspective, I mean, you can oftentimes pay things off at a short term faster if you're just going to pay cash for it. But we're thinking long term. We're in a marathon here. The other approach you could take is if you've got 0% debts, could you take some of that money, put it into an investment that makes enough to pay that bill, and then you have an asset paying for that bill?
I probably wouldn't do that.
Yeah, I mean, there's an added element of risk doing it that way, but there's different ways to string this back.
And what I'll add on to what you're saying, Craig, there is a lot of the conversations I've been having recently. People are getting stuck on the interest rates, and when you look at infinite banking, it's more about the flow of money and the control of money than is the interest or the internal rate of return, those kind of things. Yes, they can be important, but what you're doing with the infinite banking policy, how you're controlling your money, that's very important. And you got to make sure that you're looking at the bigger picture with that kind of stuff too. Because I mean, I had someone ask me the other day, I said, well, Brian, why would I borrow from my policy at 5% when I can go and borrow from the bank at 4%? And I'm like, there's multiple reasons why I would want to borrow at 5 with my policy versus a bank at 4. With my policy, it's private. I'm in control, right? It's not showing up in my credit report. I can control the payments. If I miss a payment, no big deal. That kind of stuff. Like I want to have that kind of control versus with a bank loan, maybe it's at 4%. Okay, I'm saving 1%, but guess what? I'm not in control. It's public. They're in control of the loan, and I don't want that. So that's a personal reason, but that's some other things to also consider.
Yeah, and also if you're working with a money mentor, one of the things we can do is we can do some, run some math on it, if you will, just to show the benefit of it. So if you ask your money mentor to run a debt blaster, that's essentially what you want to take a look at.
Yep, exactly. All right. Dallas said, how I found the amount of interest the policy will pay. Or actually, how do I find the amount of interest the policy will pay? I'm not too good at mathematics. They send me the spreadsheets, but no specific answer. I think you're referring to the dividends is what it's referring to.
Well, yeah, but I mean, the stated interest rate that you're going to get on the policy, the guaranteed interest rate, is in your policy contract. When your policy is issued, funded, and you get your actual policy, it's in there. Then the dividend crediting rate is declared each year. The dividend crediting rate includes the guaranteed interest rate plus that year's declared dividend. So how do you figure it out? So it's not, I mean, no matter what kind of investment you have. Now, I know most people are used to 401ks where it literally gives them the percentage. Your policy is not going to do that because your policy is life insurance. So what you got to do is, let's say you're in year 5, you take the cash value in year 5, subtract it from the cash value in year 4, right? So whatever, on your illustration, the year prior, you want to subtract from the current year's cash value. That gives you your gross gain. So like the total amount the policy grew by that year, then subtract out your premium deposit from that. So if the policy grew by $10,000 and you put $5,000 in premium deposits in, well, then your net gain is $5,000. So then you divide the $5,000 into the premium you put in that year. That gives your cash on cash return. Now, I know that was a lot of math, but basically subtract the current year from last year minus the premium. I've got a bunch of videos that explains that, but it's just, it just gets hard to find the right video.
Right. Okay. Yeah, that's a question that's come up quite a bit, and I go through that same scenario right there in the math. Uh-oh.
He's still there. He just, camera went out.
Yeah. Cool. All right. Let's see. Cal said, what day in Nashville? Can I get in touch? And they actually, I'm leaving in Nashville area, or maybe living.
Living?
So,
yeah, we're here now.
Yeah.
Yep.
We got an event the next couple of days.
Yeah, event starts tomorrow night, and then the main content's delivered on Friday and Saturday. Now, I don't know, can you still register?
We're at this shitty hotel. It's not shitty at all. It's actually super freaking nice hotel. We're a little salty. I'm salty because the people that did the check-in, she was terrible, and then the internet here sucks. But outside of that, the room's beautiful. All the hallways, they're beautiful. It's right by downtown. So anyway,
where's your Starlink system?
Yeah, well, it's probably wherever Trump is doing his rally.
There you go. I've got a couple spare ones. I actually do. All right. Julius said, hey guys, I'm living in Caraco now, a small island in the Caribbean. Yep. For part of the Dutch Kingdom. Can I apply for a customized whole life insurance policy? Short answer is no. To do infinite banking as we do it, you have to be a U.S. or Canadian citizen, or doing business here, living here. Bottom line. So if you are actually a U.S. citizen living abroad, there are some ways to make it work in some situations, but generally speaking, you have to be located here and be a U.S. citizen. So. All right. Let's see here. Oh, follow-up question. Can any insurance company offer this kind of product, like Pan America Life Insurance, etc.?
We're getting some good questions. Yeah. Let me hit this, Julius. It's a very specialized policy design that we do. And that's why we always say, and we preface it, specially designed and engineered. So there are only literally, I don't know, Brian, 5, 6, 7 that I would say work. Some people would say there's 10 that work, but I would say there's 7 that work. And of those 7, a couple of them are direct recognition, which means they don't work as well as the other ones that are non-direct recognition. So, I'm not going to name them all out, but yes, those companies you just named, I've never heard of, which means they probably do not work for this.
Yeah. And
somebody asked me if Thrivent works. I'm like, no, Thrivent does not work.
Yeah. I mean, bottom line, they have to be a mutual insurance company first off. So that's the quickest thing. Just go ahead and Google it really quick, and you'll find out if they're mutual or not. But just because they are a mutual insurance company does not mean they support or can do infinite banking. So as Chris said, there's specific companies that offer the products that do it.
Hey, Brian, I put in the private chat Jamie's email. So for those people, if you're in the Nashville area, there's a few general admission tickets left per Hannah. So she said you can just email Jamie at the Money Multiplier if you're interested. I don't know if the registration still works, so just email Jamie. So if anyone's out there, they want to join us, that's how you can get involved.
I just put it in the chat box right there. So
thank you.
Yep.
Yeah, we have some seats open because some of the folks couldn't come because they're stuck in Florida, or they're dealing with Florida. I shouldn't say stuck in Florida.
Trying to get out of Florida.
Yeah.
So, compelled cat. All right. How and where do I get a policy? Great question, by the way. How much would a policy cost upfront, and how long would you have to wait before you can withdraw anything from a policy? A lot of great questions there. I'm going to let Craig and Chris take that. I'm going to put inside the comment box the link to our mentor link, so that if you guys want to schedule a call with one of our team members to go through these kind of questions, you can go ahead and grab that link.
Yep. I'll start with the first question. How and where do I get a policy? So Brian's going to put a booking link in there, and that's us. So we are authorized infinite banking practitioners, and when you book a call with us, you can book a call with Brian if you want. Maybe Brian, just put your info in there as well.
Yeah.
And as far as how much you would be putting into the policy, that's really going to depend on your income, what you're trying to accomplish. Are you paying down debt? Are you investing? So in that strategy call, let's say you and Brian connect, you'd be able to really have a discussion about what makes sense to put into that policy. And then we always say within the first 30 days. Now, it's just going to take the amount of time it takes to put the premium deposits into the policy, get everything processed. But it's typically within the first 30 days you can withdraw a percentage of that out of the policy.
Yep.
Now, if you were to fund the policy and you wait 2 months, well, then it's 3 to 5 days. So, but that initial funding is going to take approximately 30 days in order to get the loan processed.
Yep. And additionally, I would say, as far as what it would cost, I really don't use the word cost because you're actually capitalizing the account, you're funding it. So the way I would word that is, how much is it to fund the policy upfront, or how much can I put into it to capitalize the account upfront? Because other than that, there are no expenses or costs to doing this. You never pay a dime or a cent to us, by the way. That's not how it works. There's no fees, that kind of stuff. So just kind of keep that in mind.
So we were recently at the residential assisted living convention in Arizona. Chris was on stage doing a great job, like he always does, jumping off chairs, telling a story. And I remember one of the things you asked Chris was how many people like going to the bank and putting money in their savings, and all the hands come up, right? And it's just getting your mindset in that same track of when you're making your premium deposits, it's just like going to the bank and putting your money in your savings. I mean, it's like you're saving money in your system. So, that's why we don't look at it as a bill. We don't look at it as a cost. We don't look at it as something we have to do. It's something we get to do. Just like when you save money, you typically like that.
Yep. I like this one. Eve said, watch the 90-minute video. So yeah, when you click one of those links, by the way, that I just put in the chat box or the comments, there's going to be a 90-minute video that if you haven't seen it already, go ahead and check it out. That walk through a lot of what we're talking about right now and the basics and foundations of infinite banking. So definitely watch that, and then obviously grab a time. So good comment right there, like that. All right, Rune said, I live in Norway. Can I start with infinite banking? So,
yeah, and Chris, you got a video on that.
Sure. Yeah, I'm not sure about Norway, but I don't think so. I don't think they have whole life, but I did do a video, and because I don't have multiple screens here, it's gonna be hard for me to find it, but I will look for it in a second. It's how to do the infinite banking concept outside of North America. So I'll look for that right now and try to post that up for you. But yeah, you wouldn't be able to do it the way we teach in Norway.
Yeah, there's other ways you can use other types of accounts and things like that to mimic the infinite banking concept. It's not still the same, but there are some other ways you can do some of it for sure. Now, actually, I do have a client that actually is, they're located outside the U.S., but they have family in the U.S. So what they're doing is they're having they're going to be insured. So the person living in the U.S. will be the insured. And then they own an entity here in the U.S. The entity will be the owner of the policy on the family member who's in the U.S. So in a roundabout way, that person who's I think they're in the U.K., is going to have a policy on somebody else here in the U.S. and control it through their U.S. entity. So there sometimes are ways to do that kind of stuff. Yeah. All right, another question from Julius. To understand it clear, infinite banking works only for U.S. and Canadian inhabitants, or can I also get it by starting a company in those countries being international? Yes, you can, but the bottom line is when you do infinite banking, because it is at the end of the day, a life insurance policy, there has to be a human body that is the insured. And that has to be a U.S. Inhabitant, somebody who has a green card, work visa, has been here for a while, or a citizen. But I do have people that are doing policies on someone like that. Maybe they travel here quite a bit, so they have a green card, and then they have an entity here that is U.S. based that owns the policy. So there are some ways you can do it, but just keep in mind you have to have an insured body that is here in the U.S. Another question from Brian. So when you pay your policy loan back, should you pay lump or monthly? I always say this: well, go to a mirror and look at yourself and ask yourself what you want to do. But bottom line, it's up to you. Now, that being said, like what Chris says oftentimes is, well, just mimic what a bank would do for you. So if you go to a bank and you get a loan for X, Y, and Z, maybe it's a car, or you go to your policy and get a loan for that car, just mimic what the car loan would be with the bank. That's one of the simplest ways to do it. Otherwise, it's really up to you. So lump sum, monthly, etc. Yeah.
Yeah, I mean, I'm sometimes surprised by questions like this because it is that simple. It's like if you got a credit card and you pay that credit card $100 a month and you pay the credit card off using a loan from your bank, pay your bank back $100 a month because that's the amount you used to pay them. If you got a car loan that's $500 a month, or you're thinking of taking a car loan out, it's going to be $500 a month. But all of a sudden you take a loan from your bank, and then you should pay your bank back the exact same amount, because when you paid Visa, you didn't get to keep that 100. When you pay yourself, you get to keep that 100. When you paid 500 to the car finance company, you didn't keep that 500. It was gone forever. You just got the car depreciating. But when you pay your bank, you got the $500 to use. So, if I lend money out in Private Money Club at 12%, I take the full interest, the 12% interest every month, and I put it back into the policy, unless I can't because of Mech rules. And then that's what starts the second and then third and fourth and fifth policy. So don't try to recreate the wheel. You're already used to paying the banks, and you're already probably paying the banks a certain amount. So when you use your own bank, pay yourself back the same amount you pay their bank. But some people, when they have extra cash laying around, and this happens to me, I get bonuses, and if I get a bonus and I've got loans on my policy, sure, I'll make lump chunk deposits down on it, and then I'll try to find a way down the line to move that money out again. So but I try to just stick to a scheduled payment plan back to my bank, just like I was paying their bank. I try to always set it up. Every loan I make, I set up a new recaptured amount, a new loan repayment back to my policy. I'm very methodical like that. And I think that's why I've been so successful with being my own bank, is because I took what Nelson Nash said seriously about don't steal the peas. And to me, it was pretty simple. I'm like, yeah, if I owned a grocery store, I would check out and buy the peas just like everybody else. I might ask for a discount, because I own the grocery store. But when I owned Fat Man Board Shops, when I would want to buy something from my store, I literally would check out with one of my employees. They would give me my discount, my employee discount. And the reason I did that is I wanted them to see the owner is getting the same discount they are getting. But to me, it's kind of a psychological game, because it didn't matter, because all the money was going into the cash register. And guess who owns that cash register? I do. Guess where that cash register's money's going in the end of the day? A bank account that I own. Like, it's the same thing with my bank. It's almost perfectly the same thing. Now, I'm sure there's a lot of businesses out there where the proprietor steals from their company because, like, I own it, this is my money, and they just steal it. And their employees watch the owner take a shirt off the rack and not pay for it. And guess what the employee does? Takes a shirt off the rack and doesn't pay for it. You set the example. So set the example for your own bank.
100%. And actually, to piggyback on that one, I had a client here that, by the way, had a policy, infinite banking, not through us, by the way. So they had it through somebody else years ago, didn't quite understand it, and their mindset hadn't quite shifted yet. So they had a policy loan of, I kid you not, probably $126,000 out on this infinite banking policy. They also had $75,000 of cash sitting in a bank that'd been there for months and years doing nothing for them. And so my question to them was, do you have your own bank? Yes. So why do you have your cash at another bank making them money? So they could have taken that $75,000, put it into their policy loan, parked the money there, saving them interest, by the way, but their mindset wasn't quite there yet because they hadn't quite gone through, what we all go through. But same thing. Why are you treating your bank different than you do the big bank over here that's actually making money off of your money? Yeah. So it's crazy. All right. Okay. Another question from Brian. Are dividends paid quarterly or annually? Annually at the end or beginning of your policy year. So the anniversary of your policy. Oh, I like this one. So Heidi said, I talked to the hubby a few nights ago. I think I have him on board.
Good job. That's always a tough hill to climb right there.
Yeah, because a lot of times what we'll see is there's a couple. One's gone through the Chris's stuff or gone through the 9-minute video, and the other one hasn't. And if they're both on a phone call, it's just the mindset is very different. So I always recommend, if you have a spouse that's going to be doing this, make sure you both have gone through the 90-minute video at a minimum.
I mean, I know the 90-minute video is not on Netflix. It should be, but you just get a big old bowl of popcorn, sit down Friday night, turn that sucker on, and let it roll.
Yeah, then go down the rabbit hole. All right, Daly said, I want the cap Chris have right now. Oh, the cap with the hat, but it's not available. When will it be back in stock?
Oh yeah, I bought this hat. This is one of those Melons. I don't know if you ever heard of that brand, Melon. So I bought a Melon. You can buy blanks of their hats. So I bought a Melon hat. And then I made patches, and I can mail you one of these patches if you want. Just give us your address. Email your address to Shauna at chrisnoggle.com and just say, I want a BYOB patch, and we'll mail you one.
Funny story about that, Chris. So I was at a business mastery, Tony Robbins business mastery about 11, 12 years ago. And in that, you do these breakouts where you get together with like a team of people. There's only about 1,000 people in the group or in the room, but you get like 7 of you together. 2 of the people in my group were the guys that started Melon, the company. And they had just started it. Like literally had just started it. They hadn't even started doing anything yet. And they were going to send me one. They never did, but they had the hats there. And then Tony Robbins called one of the guys up in the middle of it, and he stood up, and they were going through the business model they had for the Melon hats. And then after that is when they exploded. And so it's cool to see the ground level of, and Tony was giving them a bunch of like input and advice, and they took that advice, and the rest is history. So it was really cool to see that.
That is wild.
Yeah, cool hats. Yeah, that was that was 11 years ago, something like that. Fana said, do you have to go through the full medical exam? Well, until a little bit ago, I would have said yes. But
yeah,
so
it depends. A little different.
Yeah, so I'm having quite a few clients with One America that they're not having to go through the medical. They have a very quick underwriting process, but generally speaking, the answer is yes. You are going to have to go through the medical. It's a mobile nurse that comes out, does the blood, urine, and questionnaire. That's pretty much it. Takes about 20 minutes usually. For at least it did for me. But in some scenarios or some companies, they may waive the medical depending on your age, the amount you're asking for on the policies, those kind of things. But, yeah, it's also, I mean, when I do mine, I always prepare for them ahead of time. So I'll go vegan for like a week or two, and then fast for about 18 hours before the exam, just for fun.
Eat lots of broccoli and water the day before.
Yeah, I don't eat a lot of processed meats from the grocery store anyways. I eat natural stuff, but I'll cut it all out. And the last time I did it, I was the highest level you can get, so it's kind of cool. Zircon says, I'm 69 and may not be insurable. Can I set up, control, and overfund a policy on my 19-year-old college grandson? Yeah, potentially yes. It depends on what you're trying to do. So simply put,
well, they could, because a 19-year-old, they certainly could, because they're not a minor anymore. So as long as they got the approval from,
they're in college.
What's that?
So that's going to be, they're in college, so they may not have the income. So that's one of the challenges.
Oh, yeah. Good point.
Yeah.
You could probably do a cover page with that and maybe have a shot of getting that done.
You might be able to. So, Zircon, so what we're talking about is, yes, your grandson can be the insured body, but when the insured body is your grandson, then the policy is built or based on his numbers. So his income, his age, those kinds of things. So if the income is low because he's in college, then the policy might be limited, but you can always start there and scale it up. We would have to run the numbers, but you also can look at different scenarios where you can insure a college person for other reasons. So I would just recommend scheduling a call with one of our mentors, and we can go through the options. But I just had someone who has son or grandson, and they're in college, but they have a lot of loans, student loans. But the parent is actually paying for the loans and is on the loans. So the insurance company told me directly that if that is the case, you can insure that kid for up to the amount of the loans as the death benefit, the projected loans over their college career. The reason why, and this happened. This is why this happened. They told me this is that there was a time where a college kid passed away, unfortunately, and the parent was stuck with all of the loans for the college, and 20 years later was still paying them off. And so you can get coverage on the student in that situation for that reason, so that if something does happen to them, unfortunately, the loans are taken care of. So
I think in this situation, since the grandson is 19, he would still be considered a dependent of the parents. So then what we would be looking at is what what amount of insurance do the parents have? Because typically they're going to look at how much insurance do the parents have, and that'll drive how much the children can have. So even though he's 19, he's still considered a dependent living, they're still, if he's still, supported by the parents, then we can kind of look at the, his parents, what do they have in terms of death benefit, build a policy off of that.
Yep. So there are options. So yeah, just recommend schedule a call and we can go through those. All right. Letitia said, I have a call scheduled for Sunday. Cool. I have one credit card to pay. I use it for expenses. Would it be wise to have payroll check direct deposited into policy and then just pay living expenses?
No.
Yeah.
No, I did a video on that too. I don't I wish Nelson didn't put that in the book, but he clearly says after year 10, you could do this, but a lot of people want to pay living expenses. So I would not recommend using the policy to pay expenses. And here's why. If you think of the way the policy works and the way that the infinite banking concept works, the goal is to send your money out working for you a second time, where it's actually earning for you a second time. If you take money from the policy and you pay your rent, take money from the policy and buy diapers, that money's no longer working for you. In the diapers and the food and the rent has no tangible value. So you always want to think of it to send it out to work. And the rule I always use is if your borrow rate is 5.2, whatever it is, send it out to work at a rate higher than that. So I used to lend money to my business at 6% because I could borrow it at 5. So I borrowed at 5, lent it at 6. My company saved money, didn't have to pay the banks. I kept control of it and I made a spread of 1.
Yep. All right. Got a couple more questions here. So Brian said, you guys know of a way to get money out of a traditional IRA without taking too big of a hit? Oh, the first way is turn 59 and a half. Because once you turn 59 and a half, then you don't pay the 10%. But otherwise, I honestly don't know of a way to do it without taking a big hit. Now, there is one caveat to that I have heard of some people doing. You don't take out the entire amount. So let's say you have $200,000 in an IRA and you're done with it, or it's a 401k and you just don't want it anymore. Once again, this is not financial advice. If you take out the entire amount, you're going to put yourself into a different tax bracket. And so I have some clients, and this is their personal choice, but they're taking out a certain amount per year at a certain level so they don't get themselves into a higher tax bracket and pay more taxes on that. So they've moved the money into cash, so it's not in the markets, but it's still in the 401k. They're taking out 50, something like that per year for 3 years to fund a policy, as an example. And that reduces so instead of being the next tax bracket, which might be 5% more, they're keeping themselves in their current bracket. So, but yeah, I don't know if Craig or Chris, you have any other input on that one?
I mean, there are some unique strategies out there with oil and gas but it gets into probably more than we want to talk about here. But generally speaking, if you're not 59 and a half, you're paying that 10% penalty, plus you're paying that income tax, like Brian said. So there are some advanced strategies with moving money around and converting, but it gets complex.
Yeah. Brian, I always try to just keep them separate. It's so much simpler. Just keep qualified funds separate in a self-directed IRA, because then you can beat the bank, but using qualified funds and not have to pay the IRS penalties or taxes, and then keep your IBC money or non-qualified money separate. That's the simplest answer.
Yep. See, Julius, another question. Do you know any international insurance company that offer customized whole life insurance so I can implement IBC? I don't. Yeah. I mean, there's some big insurance companies out there that are international, but most of them don't. They're public companies. So they're going to be stock companies or something like that, and not the kind that we use. So yeah, I have not come across one that does that. Here, Antonio, if I was to purchase a convertible term policy and filed for bankruptcy, will they allow my convertible term policy to apply for a banking policy? That's a great question. I don't know the answer to that one.
I don't think there's any stipulation. Once you've got the convertible term policy, as long as it's within that convertible term, period.
Yeah, you'd absolutely be able to get a policy. I had to think that through for a second and read it twice, but yeah.
Yeah.
No matter what, you'd be able to get the policy because you already qualified for the term, and that's the underwriting they're going for on a convertible. So I think unless it was like a felony or something like that, like you'd be good to go.
Yeah.
I know in some cases they put, there's some stipulations in there, and I don't know what underwriting looks at or why they would deny it, but generally speaking, I don't think a bankruptcy would stop a conversion of a term policy.
Yeah. Now, what can stop the conversion is how long you're into the term policy. So you just got to make sure that the term policy, even if it is convertible, is still convertible. So that's something I ran into with a client where they had one. It's 12 years old. It's beyond the time limit that they'll allow it to convert. So it's got to keep that in mind. All right. Davey said, I have 3 policies. That's awesome. One is a money tree year 3. Do I slam as much additional PUA into it versus putting it evenly across them all? So you have, one's a money tree. So money tree means that it's cash on cash positive year 3, putting $1 in, getting $1 out in growth of cash value. Do I slam as much additional PUAs? Well, the question is, can you put additional PUAs into that one?
Bingo.
That's the question right there. Because I mean, if you're maxing out the efficiency of the policy, that means that you're putting in as much premiums as you can already based on how it was built. So that would be the question. If you're already maxing out the premiums and the PUAs, then I would take the additional amount of money and put it into the other ones. So it's just if there's room. So let's see here. All right. Yeah, Brian says it's in jail. Yep, your money's in jail if it's with the IRA. If I have this is Jason. Hey, Jason. If I have no debt other than a 3.5-year-old mortgage, is it smarter to invest in bonds or partially pay down the mortgage in today's environment? Well, this is not financial advice, so keep that in mind, Jason. So, I mean, the bottom line is the mortgage, as Jason, you and I have talked, that mortgage just is not a good vehicle. But if you can take the money, put it into something else that makes you a higher return, and then take those returns and put it back into the mortgage, that can be a way to accelerate that down as well. So there's a couple different approaches I would see to this. Taking money, put it straight into the mortgage, I don't like that. I honestly don't like that because now it's locked up inside the home and you can't use it. So if you put more money into your mortgage, you can't use that money for something else. For me personally, this is not financial advice. I'd rather take that money and put it through a policy or into another vehicle that then cash flows, then take that cash flow and put it into the mortgage. So I have an asset and I'm using that to pay down the mortgage.
Couldn't have said it any better. That's exactly what I would second that.
Yeah. Change
nothing. Just do what you just said.
Yep. Yeah, and Jason, if you want to talk about it, because he'd asked you this, you just got your second policy, I think, in effect here last week. So congrats, by the way. It's awesome. Yeah. What is convertible term policy? It's not a car.
I love it.
Yeah. So convertible term is just a term policy, 5, 10, 15, 20-year term policy. And if it's a convertible term, they allow you to take that policy and move it into a whole life policy with equal or lesser death benefit and not have to qualify for the term policy or the new whole life policy. You're pre-approved essentially by having the term policy. So it's just it's a nice option sometimes if you have that kind of a term policy. Brian, does the policy count against your net worth when kids fall or fill out a FAFSA?
No.
It's the opposite.
Yeah, so the FAFSA doesn't look at policies. So the more money you get in your policies, it just says it doesn't exist to FAFSA.
Okay, cool. Yeah, I don't know that. Yeah, because kind of interesting. So some people don't know this, but the cash value on your policies is part of your net worth. When you fill out most financial questionnaires, there'll be a line that says life insurance. They're not asking about death benefit. They're asking about the cash value life insurance. So you can actually add it to your net worth if you want to. So, well, cool, guys. We're at the top of the hour, or actually the top of the half hour.
Wow, that went fast.
Yeah. So
I was multitasking over here, but that was great questions. Really good questions. Yeah. All right. Well, for those of you that we're going to see out here in Nashville, can't wait. Outside of that, folks, enjoy yourself. Be safe if you're in the path of the hurricane, which I think it lands tonight, or I just got a text. That's what I was doing a second ago from one of our investors that we lend money to, and the eye just passed them. No damage, no flooding, nothing. So hopefully everybody's that lucky, and hopefully the storm slows down fast. And this was all just like the media getting us all hyped up, and I'm hoping that's the outcome after this thing hits. So take care, everybody. We'll see you all soon.
Take care.
All right.